Banks are often seen as symbols of financial security, their towering headquarters representing power and stability. But history tells a different story. Time and again, banks have crumbled overnight, taking billions in deposits with them. How can a financial institution that appears rock-solid collapse in a matter of days? The answer lies in the fragile mechanics of banking. Beneath the surface, banks operate on a delicate balance between assets, liabilities, and trust. If this balance tips too far, disaster strikes. In this two-part deep dive, we will uncover the hidden reasons why banks fail, even when they seem strong. The banking model, a risky balancing act. At their core, banks function as intermediaries. They take deposits from individuals and businesses, promising to keep the money safe, while lending a large portion of those deposits to borrowers. The bank profits from the difference between the interest it charges on loans and the interest it pays on deposits. However, this system operates on one major assumption, that depositors won't all withdraw their money at once. Banks don't keep 100% of deposits in cash. They invest in loans, bonds, and other financial instruments. If customers suddenly demand their money back, a bank may find itself unable to meet the withdrawals. This is where trouble begins. Liquidity crises, when banks run out of cash. A liquidity crisis occurs when a bank lacks enough liquid cash to cover customer withdrawals. This can be triggered by economic downturns, financial scandals, or simple rumors. When people suspect a bank might be in trouble, they rush to withdraw their money, causing a bank run. Even a financially healthy bank can collapse if enough depositors panic. The Great Depression saw thousands of banks fail due to bank runs. More recently, the collapse of Silicon Valley Bank, SVB, in 2023 happened because depositors lost confidence and withdrew their money en masse, leaving the bank with no time to raise funds. Risky loans, the hidden time bomb. Banks thrive on lending, but if they make too many risky loans, they invite disaster. Some banks extend credit to borrowers with poor repayment potential, hoping for high returns. If these borrowers default, the bank suffers massive losses. The 2008 financial crisis was a prime example. Banks issued subprime mortgages, loans to borrowers with poor credit. When the housing market crashed, millions defaulted, causing banks to lose billions. Lehman Brothers, one of the biggest financial firms, collapsed overnight due to its exposure to bad loans. The role of interest rates, a silent threat. Banks invest in long-term bonds and loans, assuming stable interest rates. However, when interest rates rise, the value of these investments drops. If a bank needs to sell assets to cover withdrawals, it might face huge losses. SVB's downfall was largely due to this issue. It invested heavily in government bonds when interest rates were low. But when rates surged, the value of these bonds plummeted. As depositors withdrew funds, SVB was forced to sell assets at a loss, leading to a catastrophic collapse. Fraud and mismanagement, internal corruption. Not all bank failures result from economic conditions. Some stem from internal fraud and poor leadership. When bank executives manipulate financial reports, mismanage funds, or take excessive risks, disaster is inevitable. One infamous case is Lehman Brothers, which used shady accounting practices to hide its massive debt. Investors and regulators were kept in the dark until it was too late. When the truth came out, panic set in, leading to the firm's collapse and triggering a global financial meltdown. Regulatory failures, when the watchdogs fall asleep. Banks operate under strict regulations designed to prevent reckless behavior. However, when regulators fail to enforce these rules, financial disasters unfold. In some cases, banks engage in risky lending or fraudulent activities, but regulators either ignore the warning signs or fail to act in time. The 2008 financial crisis was partly due to regulatory failures, as authorities overlooked the growing risk of subprime mortgages. By the time they intervened, it was too late. Banks were already on the brink of collapse. Cyber threats, the digital time bomb. In an increasingly digital world, banks face a new kind of threat, cyber attacks. Hackers can steal billions in a single breach, crippling financial institutions. If customers lose trust in a bank's ability to protect their funds, mass withdrawals can follow, leading to a financial crisis. In 2016, hackers stole $81 million from the Bangladesh bank, using malware to manipulate financial transactions. The breach exposed major weaknesses in global banking security and highlighted the vulnerability of even well-established institutions. Public panic, the psychological domino effect. Bank failures aren't just about numbers, they're about trust. When customers fear that a bank is in trouble, their panic alone can cause its downfall. Social media amplifies financial rumors, making it easier than ever for panic to spread. A single viral post about a bank's potential instability can trigger a modern bank run, forcing the institution to close its doors overnight. The collapse of Credit Suisse in 2023 was partly fueled by social media speculation, causing investors to withdraw funds at an alarming rate. Overexpansion, the growth trap. Bigger isn't always better. Some banks expand too quickly, taking on massive debt to acquire smaller competitors. While this may look like success, it can be a ticking time bomb. If the economy slows down or the bank mismanages its assets, it may struggle to stay afloat. One example is Washington Mutual, which aggressively expanded before the 2008 crisis. Its risky loans and overexpansion led to its downfall, making it the largest bank failure in U.S. history. Final thoughts: how to protect your money. Understanding why banks collapse can help individuals make smarter financial decisions. Depositors should monitor their bank's financial health, diversify their savings, and be cautious of institutions that take excessive risks. To stay informed and protect your finances, always be aware of economic trends and banking policies. And if you found this video insightful, don't forget to subscribe, leave a comment, and share your thoughts below.